This is the Jay Pitt Show.
Dave Ramsey said he has a plan for Trump to jumpstart the housing market.
Okay.
One of them was stop letting institutional investors buy rental houses, which
is something that Trump has mentioned an interest in.
Yeah, and then the other one was to up the no tax on gains up to $2 million from $500,000.
Oh wow! Okay,
thinking a lot of older folks who have a lot of equity in their house would start selling. If that's the case, now I don't know if that would actually do enough to jumpstart the economy. Now I had an idea thinking of this, and I don't think they'll ever do it, but I think you really could jumpstart the housing economy if you did people that own rental homes, no capital gains on
the sale of rental property.
Now, obviously, might make some people mad, but it's hard to have. You're getting two winners in this situation.
I think more likely, Ryan, is eliminating capital gains tax for the sale of a primary residence. The problem with that, it's just PR, better PR when you're putting on or removing barriers to sale for ordinary people rather than investors. The problem is that you can achieve the same thing with a cap. The majority of Americans, let's just say, the median home price nationwide is probably short of $500,000. And so if your home isn't worth more than $500,000, then you're not selling for $500,000 worth of gain on average. So the limit protects those people. You're really only insulating, as Dave Ramsey suggests, people that own homes north of the national median price. So you're not like really benefiting the right people there either. I could see where you're coming from as being a stimulator or a stimulus. Stimulator's not a word. A stimulus, I think, to the economy, because those are entrepreneurial people that are going to redeploy the capital. The problem that you could run into is it could lead to a lot of speculation that drives prices up and makes housing less affordable. So I don't really know. It's an intriguing thought and certainly would benefit me, because I own a lot of real estate. I tell you what is happening now for individuals that like older folks, let's say, that have a lot of equity is, in a lot of cases, they're leaving it to their kids who get stepped up basis and eliminate the need to repay depreciation. And there is no capital gains tax because you're just not selling. People will, potentially even borrow against their real estate again. Because that's like truly the tool of the rich, right? Is they own assets free and clear in a lot of cases that they borrow against, and that borrowing becomes a subsidy for income. Income is taxed. Money borrowed against assets is not. So in fact, when you borrow against a real estate asset, then the interest is tax deductible. Beyond a certain amount. So beyond the alternative minimum tax. So it's just like, I don't know what the answer is. I think it goes back always to stimulating the creation of inventory, as we discussed last week, right? You have to create inventory if you want equilibrium, because demand still exceeds supply. So, I was told yesterday by one of our agents here that they had a client that is a bit of a conspiracy theorist that has put their search on a shelf because they read somewhere on X that there's going to be a housing crash because of lack of affordability. Affordability is about one thing right now: demand exceeding supply. The supply side does not meet the demand side, and so prices continue to rise.
Yeah.
It's that simple, right? Not only that, we continue to look for ways to stimulate demand when we don't need to stimulate demand. We need to stimulate supply. And, I think that kind of pivots to what I wanted to talk about here locally, because we had an enormous January. Okay. But that was even with like the last 2 weeks of January being under a foot of snow. And so we saw next to no activity then, But now that we've melted, we've thawed, activity is picking up substantially again. So, I think it's important to have interest rates at a place that does not stifle growth, but it doesn't promote growth either. The market needs to be allowed to do what it does. In the absence of creating inventory, I think we need to be okay with 6 to 8% appreciation a year, because that's more realistic. If we could stimulate supply, 4% growth would be, price growth or appreciation in real estate would be fine.
Yeah.
We could have more transactions.
6 to 8% appreciation is unbelievable. Let's say you're buy a $300,000 house, but you only had to put $60,000 down.
Yeah.
You're getting the appreciation on the $300,000 and not the $60,000.
Exactly.
It's unbelievable.
Yeah, it is. And it goes beyond that. We did a reaction video yesterday of a gentleman that does long form, short form, like 10-minute videos that are by rent analysis in markets all over the country. And he did Louisville, and essentially, no shocker here, you should buy here based on his analysis. Now, it's not a home run difference because of the lack of affordability, but rents are just as high. And basically what it comes down to is the fact that, he found that your appreciation will essentially outweigh your payment savings. You're going to pay slightly more to own and maintain a home than you are to rent. Okay. But you're going to get appreciation that outweighs your payment savings over the course of, say, 5 years. And so, those traditional kind of points that we make about this, they hold true. And, it doesn't hold true in certain markets around the country where prices have, gone sky high. Southern California, South Florida, New England, certain hot markets. But, the truth is 6 to 8% appreciation is phenomenal. You should be happy with that. 4% you should be okay with if we can create more inventory. And if you really want to stimulate the economy, we need to get to 4% growth, not 6 to 8, because that 4% comes with the creation of a lot more inventory, which will bring with it transactions, which will have ancillary impact on the income, on the economy.